Hey everyone, D-Cope here to welcome you back to IPA8. I am super excited to be here, and this is all for educational purposes only. So here is where we are in the course outline. This is day 3 of week 2, so we're right in the middle of mechanics of the market. And next week we're gonna actually create your plan. And last week we talked all about your mindset that you need to be in. So today we're going to be talking about timing, cycles, and seasonality. So we're going to shift focus from the commodities and the currencies, and we're going to talk about time frame, which is crucial. It's the most important thing into understanding how the market works. And there is an ebb and flow to the market, and there is a rhythm to the market. So what we're going to talk about today is time frame, and then the flow of price over time, and how to know what chart to use. And then we're going to get into some of the seasonality of trading, like the January effect and sell in May and go away, and then even some statistics about the presidential cycles and how that influences the market. So, there is a rhythm to the market. And it comes down to what tools you're using to measure the market, and how sensitive are these tools, and are they really complex, or are they rather simple? So there's all different sorts of time frames, and at the end of the presentation I'm going to take you out of the slides and actually show you the different time frames in that are available to you online. So it goes all the way from the 5-minute chart to a monthly chart. And on a 5-minute chart, each 5-minute interval is measured, and there's a price range given to that 5-minute interval. Now, when I first started trading, I didn't even know this existed. I didn't know people used this to trade, but it is a really effective measure of the intra-period movements during the day. So, and then it goes all the way out to a monthly chart, as to where each blip of information, that's known as a candlestick, and we're going to talk all about candlesticks tomorrow. So don't worry all that much if you don't understand candlesticks, because I'm going to get into them. But so on a monthly chart, each candle would have the monthly range. And that's basically the essence of a candle. There's 4 points to a candlestick, and I'm going to talk about that tomorrow. But for now, just know that a candle is used to measure the range, and it always has the open price and the close price. So in the market, you're going to see long patterns and short patterns. And this is a really good graphical representation of the sine waves involved. So the bold line is the longer pattern, and the smaller squiggly line is the shorter pattern. And you can kind of see that there's 3 or 4 short patterns before a reversal in the longer pattern. And in the market, you're going to see this. And hopefully you can come back to this visual and think, wow, this is what I'm missing. This is huge right here. So this is a daily chart, and each of these candlesticks represents one day. So you can see for the most of December, the range was in between $1.50 and $2. All the opening close prices were, looks like they were in between $2 and about $1.70-ish. And then all of a sudden in January, there were these big moves higher. And it's not so important as to why this moved a certain way, but just kind of think of what you see on the daily chart. So okay, January 4th is when there was that big move higher. So if you zoom into a shorter time frame, let's say the 15-minute chart, you'll get a better idea of that daily movement. Did it move up all at once? Did the move happen in 5 minutes? Or did it happen throughout the day? And that's really, really important to know. And so when we zoom in to a closer time frame, you want to think of it as zooming in like you would on a microscope. So when you're zoomed out, we'll call the daily chart 1x. So when you're zoomed out to 1x, it's kind of, things are kind of a little fuzzy. You don't get a good idea of what's going on. So if you zoom in to the 15-minute chart, that would be like zooming in on a microscope 26 times, because there's 26 times more candles on the 15-minute chart than there is on a daily chart, because there's 26 15-minute intervals in one day. So we can see that huge move. It didn't just happen in the first 5 minutes of the day. The company didn't get bought out, whereas you would have just seen the price, at that level, and for the rest of the day. It happened over time. So this is the 15-minute chart, and it's an eye-opener. It can be a real eye-opener as to how the move happened and when it happened. So next is the 5-minute chart. And the 5-minute chart is actually, I believe it is, let me look. So it is 78 times zoom. So the 15-minute chart is 26 times zoom. And then the 5-minute chart is 78 times zoom, because there's 78 5-minute candlesticks in one day. So you can see that right in the morning, there was a huge move, and this move from 240 to 280 happened over 1, 2, 3, 4 candles. So if you happen to see this in the morning, say before 10 a.m., and you were thinking about buying into this company, to get a price below 240, you would have needed to buy in before 10:15, and after 10:15, you would have no longer been able to buy this company at 240. So if you placed a limit order for 240, it would have not gotten filled after 10:15. And 20 minutes later, if you placed a limit order at 260, it wouldn't have got filled either. Now that's a pretty large move from 240 to 280. It's 16%, and that happened in 20 minutes. So it is possible to capture large daily moves just from looking at patterns on a 5-minute chart. So hopefully this is eye-opening as to how you can make money day trading. You definitely need a solid strategy, and you need to be looking at chart patterns. And not everybody can do this, but if you have the right tools in your toolbox, then you definitely have an advantage over the majority of traders. So the price flows over time, and it's the master that recognizes the break in between time frames. And really, to truly master trading, you need to be looking at all of the time frames. But that's difficult if you're a beginner trader, because it can get confusing. So if you're a beginner and you're just learning about the different time frames, you just want to pick one time frame for now. And you want to pick that time frame based on your desired hold time. So as your hold time decreases, your management time will increase. So the day trader who plans to be in and out in that same day, there's 6.5 trading hours in a day, so he would be actively managing his positions. He or she would be actively managing their positions. He or she would be actively managing his or her positions over time. And if they're using a 5-minute chart, I suggest to check the prices at least hourly, if not more. You have the capability to get new data every 5 minutes. So I know some day traders that are looking at every single 5-minute candle, and they are seen as pretty reliable. Now, companies that aren't really actively traded all that much and have smaller trading volumes, when you zoom into a 5-minute chart, you may not see a lot of activity. You may not see a lot of movement. It may not look like it's flowing. So that's when you know that you need to zoom out a little bit on your time frame. And we'll get into all examples of this later when we're talking about creating your plan and even qualifying trades and executing as well. So how do you know what chart to use? So most day traders, their whole time is like 5 or 6 hours if they're buying right in the morning and selling at the end of the day. In which case, I would say that you need to be looking at the 5-minute chart and the 15-minute chart. When you're day trading, the daily chart is not as important to you. And I would suggest a minimum checking the price hourly. And like I said, most day traders I know are checking every 5 or 15 minutes. And if you were holding for a week, say in a swing trade, I would say you definitely need to be looking at the 15-minute chart and the daily chart. And you definitely want to be checking the prices at the close and daily. So the daily close prices. And if you were looking to hold for longer in the staying in the game style, you didn't want to actively manage your positions as much, you'd be looking at the daily chart and the weekly chart. And I would say you absolutely want to check the price every week. You don't just want to let an investment go. If you want to do that, then that's fine. But I would have a lot more confidence if you were at least checking the prices weekly. So let's talk a little bit about seasonality and the January effect. So traders and investors hold until year end in order to delay capital gains tax until the following year, because capital gains tax is applied the year that you close your position. So if you close it in January, you don't have to pay taxes on those capital gains until basically 1 year later, or until you file your taxes. And you're not going to find this if you just look online at the January effect. This is not what the January effect says in Investopedia. And you're gonna find a lot of, I wouldn't, it's misinformation, but maybe Investopedia had good intentions, but the road to hell was paved with good intentions. A lot of people put information out there, thinking that they're helping, but it's wrong or it's flawed, and you just have to be really, really careful of where you get your information. So the top 10% of stocks outperform the market month in and month out, with the exception of the month of January. January is seen as not a good month for trend trading. It's January is a time when traders and investors take profits on big gains. And this knowledge is pretty important, and it can be to your advantage. So another seasonality thing is sell in May and go away. So traders and investors, they take vacations in the summer like everyone else. And that's why the summer months are generally have lower volume. Does that mean that you shouldn't trade in the summer months? No. of course you can trade, and of course you can make money in the summer months. It's just an additional thing to consider when you're taking positions in the summer. And you may want to shoot for more modest targets in the summer. And the presidential cycles as well. So going back, looking at historical prices, it's been the third year of a presidential term that's had the most gains in the market. Now, does this mean that every presidential cycle, the third year of the presidential cycle, is going to be a great banner year? Of course not. Of course not. Is this a reason to make a trade? No. Is this a reason to avoid a trade? No. But I know it's significant. I know it's significantly higher in the third year. So definitely look out for that. And then the next year, the third year of this presidential cycle is 2019. So in 2019, don't be surprised if the market runs 20% or 30% higher. So that gets into the action item today before I take you on FinViz, and I'm actually going to go in Coinbase as well, because all of these, everything that's traded that has a price history, you should be able to look at different time frames. So the action item today is to pick a time frame to concentrate on initially, whether it's day, week, or month. So I'm just going to exit out of the presentation, and I am going to go on to FinViz. And I'm just going to bring up, Amazon, and just give you an idea of moving between time frames. So this is the daily time frame, and so if I clicked on intraday, you can see all the way down to the 3-minute time frames. And so 3-minute, and you go to 5-minute, and 15-minute. So this is 1 week. The 15-minute chart covers 1 week. And this was the daily that we started on. And then if you click on weekly, you can see all the way back to almost the beginning of 2016. And then monthly would be the longest that FinViz shows, and it goes back to 2010, where Amazon was under $200. So in the last 8 years, Amazon's up about 700%, probably more. And those are your time frames. And if we go on to Coinbase and we were to look at time frames of cryptocurrencies, we can see that there's a similar feature on Coinbase. So right in this upper right hand corner, you can see that you can come down to the 1 hour time frame, and then that's the range for the day, and then that's the range for the week, and that's the range for the month, That's the range for the year. And then there's the entire price history back to January of 2013 when Bitcoin was $14. So, and then, same thing with the other currencies. And you can see, back when Ethereum was taking off and it was under $1, and now it's over 1,000. So these are huge percentage moves. You're not going to see these in the stock market too often, if ever. But the time frames, they're the same in analyzing the data. And you want to be looking at your time frame for the hold time that you're considering. And that's important. That's super important to realize. Probably the most important thing that you want to realize is what's your hold time, and match that to the chart that you need to use. So that's all I have for today, and I will see everyone tomorrow.